Welcome to INDepth. I'm Peter White, and my guest today is Zehrid Osmani. Zehrid, welcome.
Thank you, Peter.
Can we start by elaborating on your investment strategy for the fund?
Yes, absolutely. We manage equities on a global basis. We focus on finding the very best ideas. So we're long-term in terms of our time horizon. 5 to 10 years is how we define long-term. We're unconstrained in so much that we don't worry about benchmark exposures. We focus solely on finding the 25 very best ideas that come out of our research and harnessing them in high conviction funds. The second aspect of what we deliver is quality growth is the type of stocks that we focus on. It's actually sustainable quality growth. So investors know what they get. And the third aspect of what we deliver is the way we look at or find these quality growth stocks is through fundamental research that we do in a systematic manner. And by systematic, we mean in-depth, consistent, structured fundamental research.
Your team's just released a major report on cybersecurity, and of course it's very topical in Australia at the moment. Can you give me your thoughts on that industry, what's happening there, and your thoughts on companies in that area?
So there's a few aspects to highlight. Firstly, when we do research, we look at 3 mega trends, and within those mega trends, we look at different themes. Cybersecurity is one of those, which is what led us to zoom in on that theme, do some research, and ultimately write this report that you mentioned. And what's interesting is when we look at IT spending, we forecast IT spending to be growing at about 6% per annum on a compound basis over 10 years. Cybersecurity spending within that IT spend, we forecast will be growing at 20% annualized. So much more spending in the IT spending of corporates going towards cybersecurity. 4 reasons that are obvious. Cybersecurity is a major risk for corporates, and that's a risk that they need to tackle. Many corporates have underinvested in that space, and they need to therefore get up to speed with having the right level of defense to protect their IP, to protect their customers' IP, and to ultimately protect their reputation. And what we're highlighting in the report is that cybersecurity is a major threat, both impacting governance, so good governance means good level of spending on cybersecurity, but also sustainability of a business model. If you have a business model where customer trust gets impacted, reputational risk gets impacted by cybersecurity breaches, and ultimately your business model is not sustainable in the long term. And for us as investors, clearly impact on cybersecurity breaches means impact on revenues, potential litigation costs, reputational damage, brand damage, which ultimately all impact shareholder value. And therefore, for us as investor, assessing each company by whether they manage cybersecurity properly is critical.
Is there, or are there particular geographies where there's less awareness? Are there any particular laggards geographically? Say, is it companies behind the 8 ball more in Europe than, say, the US or in Asia? Or is it across the board?
It's across the board. Yeah, it's a good question, Peter. We haven't really detected a pattern geographically. It's more across the board. You have to go company by company. Some companies are ahead in terms of spending more on cybersecurities, and others are still needing to catch up.
It's fairly random. What about opportunities for investment? What are there particular companies you've got your eye on or you like?
We've been looking at opportunities within the landscape, and what we have found is that the landscape is very fragmented and the competitive intensity is very high. There's potential trends towards more consolidation, but that consolidation is very difficult to predict. So on the whole, whilst we like the area, given the growth that we highlighted earlier, growth potential that we highlighted earlier, we have struggled to find the right opportunity at the stock level.
Your business is growth-oriented companies. What are your comments on where the market is? It's been very volatile. Have companies overshot down or up at the moment? What's your feeling of value in that area?
What we find is that the market has been very mechanical in marking down share prices for quality growth companies because they're long duration. And as monetary policies have had to adjust upwards, these long duration names have been impacted negatively in a very mechanical manner, which really means that fundamentals have not been an area of focus for the market, which as a result, and to answer your question, has opened up some really good opportunities of businesses that are profitable, that have resilient growth, that have attractive structural growth opportunities, that have solid balance sheets, pricing power in what is a higher and longer lasting inflationary environment, and that we believe are now very undervalued.
So ironically, you're finding value not that difficult to find.
No, that's right. And the importance of this is valuation discipline. So we've always been valuing any of these companies with the assumption that monetary policies are going to normalize. So our long-term valuation tools have been using a high discount rate with a risk-free rate assumption of 4%, even when rates were at 0% or in some geographies below 0. And certainly below 1 across the world. So having that discipline, having that conservative assumption that rates were going to normalize was the important aspect of having valuation discipline.
So inflation is not going to change in the near future from what you're saying?
Well, the way we're looking at inflation is frictional rather than structural, and it's related to various supply shocks, quite severe supply shocks that have been happening to the world, not least the pandemic crisis globally. But also this year, we've had 2 additional supply shocks. One has been the Russia-Ukraine conflict that has led to flare-ups in various commodity prices, notably energy. And the second one has been China lockdowns of various regions within their territory, which have again exacerbated some of the production bases, some of the supply chains have been impacted again. However, what we're also highlighting to investors is that in the midterm, a large part of inflationary pressures come from wage inflation. And so all eyes really are on wage inflation in our view. When you look at wage inflation, looking at Europe, Australia, or Japan, wage inflation is not running away. It's not anywhere abnormal compared to the long term at this stage in the cycle. Where there's an issue is in the US, where wage inflation has been accelerating. So for the US, we believe that frictional inflation has more risk of turning structural, and therefore it's important to keep a close eye on that.
But probably greater need to play catch up in the US too, though, for the wage earners, some would argue.
Yeah.
What about risk management? Can you give me your philosophy or how you manage risk management in this portfolio?
Risk management is critical. We are stock pickers, but we always highlight that unlike some stock pickers that just focus on finding ideas, researching them, and if those ideas are good, they put them in their strategies, we have a third step in our investment process, which is portfolio construction, whereby once we research the stocks, we then have a good understanding of upside potential, but also a good awareness of the risks that these stocks bring to the portfolio. And so we move to step 3, which is building portfolios that are high conviction, concentrated, but diversified at the same time with no unintended risk exposure. And on that front, we focus a lot on finding or analyzing portfolios in ways that the traditional risk tools do not permit. So we have put in place some proprietary fundamental assessments that give us better insights on how portfolios are positioned and therefore how to achieve diversification. I'll give you a few examples. Geographic exposures. So traditionally, in the traditional risk tools, the portfolios get analyzed by where are your stocks quoted, and therefore this is your geographic exposures. You might be overweight some stock markets and underweight others. What we do is we look at companies' exposure of revenues and profits and even production basis geographically in a very detailed manner. That way, we know the portfolios more accurately in terms of geographic exposures. We manage diversification more efficiently, and we can point the research where we need to do more work. And the great example was, for example, when Russia invaded Ukraine earlier this year, we were able to assess how much exposure we had to Russia and to Ukraine by revenue, profit, and production basis, which companies were giving us that exposure, which permitted us to then decide whether we needed to pay attention to those stocks and take action on those stocks. That's just one example of achieving.
And was a big rebalancing involved as a result of that?
There wasn't, because global strategies were only about 1% exposed to Russia on revenue and profits, and about 2% exposed to Eastern Europe, of which most of that exposure was Poland, Hungary, and Romania, very little to no exposure to Ukraine. Another example of diversification through that more accurate risk assessments of portfolios is end user market exposures. So what we do is we assess each company in terms of what are their end user markets ultimately. And we then have a more accurate picture of what industries we're exposed to. Because you could have a company that is in the materials sector, but actually whose end market is construction. You could have a company that's in the industrial sector, and it might be an air compressor equipment company, and that end market is construction again. And you might have a company in the technology space, but perhaps it's a software company that sells to the construction industry, a company like Autodesk, for example, in the US, and that therefore gives you exposure to construction. So you might think that you have 3 different stocks in 3 different sectors, when actually all 3 give you the same end market exposure. So assessing by end market gives you a more accurate picture, which permits you to diversify better, even in a 25 stock portfolio. The third aspect of how we diversify is through the thematic lens. We mentioned earlier how we look at 3 megatrends. The 3 megatrends we've identified are demographic changes, future of technology, and resource scarcity. In 10 years, 20 years, 30 years time, Peter, hopefully we still talk to each other, we'll still be talking about these megatrends. There are themes in each of these megatrends, and we've listed those in an accurate manner. And what we're doing when we're assessing companies is assessing which themes are they exposed to on a forward-looking basis rather than in a rear-view mirror basis. And we're then assessing across the portfolio how many themes we're exposed to through all these companies and to what extent we're exposed. Which means that at the end of that process, we're able to have a good understanding of which themes run through the portfolio, to what extent we're exposed to them, which permits us to be more accurate, which permits us to be diversified thematically, and permits us to also have a good visibility on what themes we might not have researched that we want to do more work on. Ultimately, it permits us to put our clients' assets on long-term structural growth opportunities, which is what we're trying to achieve.
Well, speaking of that, are there any particular sectors or themes that you're very hot on at the moment?
So we have identified 8 midterm opportunities within the thematics. 4 of them are on the infrastructure spending. They are green and alternative energy as a way to decarbonize economies. Secondly, energy efficient buildings, again, another form of decarbonization. The third one is electric transportation, again, as an aim of decarbonizing, and that's both electric vehicles and high-speed railway. And the fourth one on the infrastructure spending side is healthcare infrastructure. We're just out of a global pandemic. No government in their own mind will be looking, or every government will be looking at spending more on healthcare infrastructure. On the other side, there's another 4 which have been accelerated since the pandemic. One is 5G telephony as a way to make economies more competitive. Secondly, we have cloud computing because more corporates have migrated their presence online. As a result, spending more on cybersecurity, back to the earlier question, is an important thing. The third one is robotics and automation. Companies have understood the need to make their production bases more resilient, their supply chains more robust, and therefore an increased spending in robotics and automation is how they're going to do it. And finally, nascent but fast-growing opportunities, metaverse and quantum computing.
And well, obviously energy is in that mix. How do you analyse you're based in Europe, how do you analyse the current energy situation there, which you seem to be in the eye of the storm? I mean, it's global, but certainly focused on Europe, given its reliance on Russian energy. What do you make of that situation?
Yes, you're absolutely right. For Europe, it's clearly been an important and challenging aspect of diversifying their energy supply away from Russian gas, looking in the medium term at totally not depending at all on that energy supplier. And therefore, there's a lot going on, both politically and in terms of investment intentions towards alternative energy sources. So in the medium term, this is an important theme. In the shorter term, it creates some geopolitical risk. There's potential risk for the region of having energy rationing into the winter, especially if we head into a harsh winter, and that could impact economic activity. So near term, you could have higher risk of stagflation in the European region. Medium terms, there's some very strong opportunities in terms of drivers of infrastructure spending in that alternative energy source.
So short term, the situation is fragile. It's not just headlines.
It's uncertain for the economic outlook, absolutely.
So thank you very much for talking to us today.
Thank you, Peter.